Hi, welcome to the Market Alert for Friday, the 12th of July 2019. So, caution, don't let the headlines fool you. Look under the hood. And this is something that I've done for many, many years. Never believe the headlines, that's for sure, whether it's mainstream news or whether it's market news. And as it says here, the Dow Jones 27,000, S&P 3,000. So the headlines and the president celebrate. Don't let the headlines distract you. Look under the hood. This rally is technically weak. It's as weak as the reason for it. And here we go. The Fed, central banks, creating more liquidity. I'm not going to read all of this, but this is the perfect piece about what we're going to see. And it saves me having to talk about this myself, because this is exactly what my thoughts have been for the last few weeks. Lowering interest rates is rooted in desperation. Watch out, investors. While rate cuts, low interest rates and central bank intervention have been kind to asset prices over the last 10 years, a rate cut this month may eventually be bad news. It will be bad news, not eventually, but it will be. The facts reveal an uncomfortable truth. Cheap money has not resulted in sustained new growth. Just look at the GDP figures since the great financial crash. But it has produced an unprecedented explosion in debt. Too right it has, whether that's stock, bond, housing, or whatever. And the Fed solution is now to offer more cheap money by cutting rates again. So what seems like a really good thing on the face of it is not going to work long term. It simply can't, because there's been no recovery, and the markets have just seen the influx of the cheap money, but eventually the penny drops and you will see things change dramatically. Okay, so let's have a look at yesterday. This is the pre-market for the Dow. You can see how prices traded down to the 200 bar moving average and eventually managed to lift itself off this, move away from it, and then you can see the battle in the first part of the session. Both the first two trades there getting caught up, ending up in a losing phase. As prices then retraced, you see the retracement, market found support and then headed to the upside, where we then find a retracement here before the market then moves lower. Not by a lot. Again, if you were to measure from here to here, you will find again we've got a 50% retracement, and then prices moving back to the upside there on the overnight and spiking quite nicely. So if you look at the daily chart, you can see we've gone straight through the recent high. We're way above 27,000. It begs the question, is 30,000 on the cards before we actually see this market stop? It seems to be a big round number where prices could trade to. It doesn't seem that impossible to me. You only have to look at the weekly charts and the monthly charts. The only thing that I will say, though, is that if you look at the monthly chart, all of the corrections were rather mild up until 2015, and then Trump gets in. But you can see it's become a bit more volatile, and this you can see more in the weekly chart. So even though the market does want to go up, just look at how violent the corrections are and have been in this market. This one in particular, not so much in December of last year. Even so, it does beg the question, how much longer can this be maintained, as you look and see how far this market's come up from 6,000 in 2009. Eventually, they all come back to fair value. But whilst you've got the liquidity from the Fed, as I've kept saying for years now in the Market Alert, they want the market up, and they're going to try and keep this up until Trump's re-election. That's what they're aiming for in 2020, which is not that far away, unbelievably. I don't know where the last 3.5 years have gone, but there you go. Meanwhile, in the pound, not a lot to report, apart from that we're at 4-year lows in the pound at the moment, bouncing a bit yesterday. Again, not a lot to report there at this time. And Bitcoin yesterday as well We saw the sell-off in the overnight market with a couple of trades to the downside. Then they bought back and didn't go too far before we got another sell. The market then rounded over into the overnight, but quite a range bound day for yesterday. And then you can see them buying back in here on the overnight session, and the market now moving back towards the upside here. Meanwhile, in other news, Deutsche Bank, a bit of a bounce for this yesterday, but making its way back to the 200 bar moving average there, and that's yesterday. Get rid of that as well, we don't want that. And 10-year yield, this is also for yesterday, but if we go to here, I think we can see that this is the current picture for the 3-month 10-year yield, still inverted. The only one that is actually, all of the others are spiking to the upside. And as you will see, if we go back to here, that before you get the recession, you always get the inversion, and then you will get a spike in the yield, so you know that it's en route. At the moment we're still showing the red, but eventually you will get this spike in the change in the basis of the two. And then finally, I can find it, implied volatility making a new low yesterday. If this chart looks different, that's because it is 1045 new low. Here's an observation for you. I'm running an average through the implied volatility now, and I can see that when it's below the average, the market continues to rise. You see where it breaks back here. This tells you that it's going to rise, the same as when it breaks back here. You can see the market continues to rise. So at the moment, the market remains long until they can see some sort of risk with a close above the average line in this chart. A very good chart indeed, very useful, very, very predictive now. So I can step back and just wait to see. And it's a leading indicator, it's not a lagging indicator. So the research that I'm doing at the moment is coming out as I thought it may do. So yeah, very simple. As you can see here, you get the market closing above the average, not the market, the implied. And then we get a correction, but as soon as it closes back below, the market moves higher. And again, as soon as it closes above, we get a correction. As soon as it closes at or below, the market then moves higher. Not until here we get a correction, and all the way through to this bar where we get a bit of stability, and then we break back through. And we try and hold, and then eventually it moves lower. But there you can see, once we get to this point, it's back to the upside. So as a leading indicator, I wouldn't expect anything to happen as far as the Dow is concerned until they mark the options back up now. Just wait for a close above the 10 bar moving average, and we'll see some weakness coming into the market. That's what the picture is so far. This is only tentative at the moment. And again, you've got to see this unfold in real time, but the implied certainly indicating that, and that's what we saw in the initial opening of the market alert, caution, weakness ahead, without a doubt, unless they go back to printing money and then helicopter money, but who knows. But the thing is, we can see what they're doing. That's the key, and then we can take action accordingly. Okay, that will do it for this one. If there is anything else to report today, I will let you know. I don't think there's any news today. Let me just check this before. We just got the US PPI at 130. Nothing to shout about there. Okay, that will do it for this one. Have a great weekend. As ever, thanks for watching. See you in the next.